Hello and good morning. Welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day.
What the world needs now is people who see flight a little bit differently. Because seeing a better connected world isn't far in the future. We're building it now. GE, building a world that works.
A year after coming out with Information Technology IT Rules 2021, the government recently proposed a clutch of changes to them, including setting up panels with power to override any decision taken by grievance officers of social media platforms like Facebook, Twitter, and YouTube. But the draft was withdrawn for some changes on Thursday. While we await the revised version, let us understand what the original draft proposed and its likely impact on social media giants.
The release of a draft proposal seeking public comments on some amendments to Information Technology, Intermediary Guidelines and Digital Media Ethics Code Rules 2021 and its hasty withdrawal has offered some glimpse into the government's plans vis-à-vis social media platforms. The Ministry of Electronics and Information Technology, or METE, had come out with the new IT rules last year, which came into effect from 26th May 2021. The rules put in place a framework for content regulation by online publishers of news and current affairs content and curated audiovisual content. The aim of the 2021 rules was to make social media and internet companies having more than 5 million users more accountable for the content on their platforms. The 2021 rules had mandated that social media intermediaries publish rules to curb posting and sharing of content which is inflammatory, objectionable, hateful, racially and ethnically objectionable, etc. The online intermediaries were also told to appoint a nodal officer in India who is available round the clock to help law enforcement agencies. Through the rules, the government had prescribed a 3-tier grievance redressal mechanism. But so far, if any user was not satisfied with any social media platform's grievance redressal system, he had only one option, and that was to approach the court. On 1st June, the draft that METE had put on its website proposed setting up of government panels to address such grievances. The draft was taken back the next day for some changes. So, before the government amends the proposed amendments to the IT rules and comes out with a new version, let us see what all it had proposed. One of the key proposals of the draft was that the government would establish one or more grievance appellate committees, which would be made up of a chairperson and other members appointed by the government. Under this amendment, a user would be able to appeal a grievance officer's order in front of the committee within 30 days of receiving it from the former. For its part, the committee would have to endeavour to resolve the appeal within 30 days of receiving it, and the concerned intermediary would have to comply with every order passed by the grievance appellate committee. The 2021 rules did not have a provision for such a grievance appellate committee.
I believe the grievance appellate process and mechanism that's been sought to be brought forward in the rules is a right step in the right direction, because the IT rules 2021 were pretty unclear. What happens if you're not satisfied with the decision of the grievance officer? Now, one option is that you can either have to file a lawsuit, because most of these social media companies are not state, therefore you cannot take them in the writ jurisdiction. At best, you'll have to file a suit for damages, for injunction, and appropriate directions. Now, for the first time, an appellate mechanism has been put forward for people who are not satisfied with the grievance officer's decision. That's one more level that's been added so as to reduce the ultimate quantum of litigation that's going to come forward in the context of social media disputes. I think any kind of addition of new compliances could be seen as onerous, but we have to ultimately look at a golden balance, a harmonious golden balance between protecting the rights of the users on the one hand and also protecting the rights of the intermediaries to seamlessly continue doing the business in India on the other.
The draft said that an intermediary would have to acknowledge a user complaint received by its grievance officer within 24 hours. This would specifically apply when the complaint in question is about user or account suspension, removal, and blocking. Also, if the complaint is for the removal of information or links that infringe copyrights, are pornographic, or are defamatory, among other things. The concerned intermediary would have to respond to requests for removal within 72 hours. However, the draft also said that the platforms were allowed to set up safeguards against the misuse of such provisions. Under the 2021 rules, an intermediary had to acknowledge a complaint sent to the grievance officer within 24 hours and dispose of it within a period of 15 days from the date of receipt.
I believe the reducing of the time effort or the time period for redressal of grievances may appear as news or may appear as music to the ears, but I think it still does not meet the expectations of the general public. Under the existing IT rules, if you do a grievance with a grievance officer, the officer has to acknowledge it within 24 hours. If the grievance has got to do with something which is pornographic or obscene, the content has to be removed within 24 hours. For all other non-sexual grievances, the existing time limit is 15 days. The proposed amendments are seeking to reduce the time limit for redressal of grievances from 15 days to 3 days, which I think is a great step forward. But then you still are allowing the intermediary to have the license to let on the criminal activity continue unabated on its platform and let the user continuing to suffer on a 24/7 basis for the next 72 hours after the grievance has been filed. I think that's neither very reasonable nor very fair to the users. Yes, from the standpoint of intermediaries, it requires added inputs, added efforts, but then hold on. Intermediaries are taking the cream out of the Indian market. They are ultimately earning out of Indians' data. They know fully well India does not have a data protection law. They are merely taking the data of Indians outside India. They're monetizing the data. They're doing everything possible to generate all kinds of money from the data and information that their users provide us. Now, here for the first time, the law is saying, hey guys, be more accountable. Try to be put in your mechanisms so that you can address your grievances within 72 hours. On a personal note, I would have expected that the time limit would have been reduced to 6 hours because on the internet, every minute is one age. The Supreme Court, in the case of Shreya Singhal versus Union of India, categorically held that intermediaries cannot be judges. So we don't even want them to be judges. We said once a grievance has been brought to you, please go ahead and remove it. So I don't think this 72-hour period is a much shorter period. Please understand the intermediary is not required to issue show cause notice, is not required to issue call for responses, nor is it required to get or lead evidences on one side or the other. It's not a court. It's only a service provider. And it's only been asked to remove certain content, which is in violation.
Under the 2021 rules, big social media platforms such as Facebook and Twitter were also mandated to enable the identification of the first originator of any information that undermines the sovereignty of India, security of the state, or public order. It is clear that some changes to the country's technology and social media regulations are in the offing, even if we don't know their exact contours at the moment. This will have a significant impact on social media giants, for whom India is a key market, which has not saturated yet and has upside potential left to it. According to Statista, more than 50% of India's population was accessing social networks in 2020. By 2025, it is estimated that social network penetration would be 67% of the country's population. As of February 2021, affordable data and mobile phones, along with the government's Digital India initiative, have resulted in India's digital population reaching approximately 624 million active users. According to Statista, India is the world's second largest internet market at this stage. However, even with the overhang of possibly onerous regulations, India is a market social media and tech giants cannot afford to ignore. And that's not just because of its size, but also because of the revenue it generates. As domestic media companies have lost ground and revenue, Google and Facebook have emerged as the main beneficiaries of India's booming internet advertising market. According to a media report, recently the combined ad revenues of Google and Facebook came out to be higher than the combined ad revenues of the top 10 listed traditional media companies. However, one major concern, which is whether or not the now withdrawn draft proposals or the ones that will come out soon will lead to enhanced government censorship, needs to be addressed.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
From online content, let us move on to online learning. It has been over 4 months since we witnessed the last wave of pandemic peak. Most schools and colleges are now open, and edtech startups which proliferated during the last 24 months are now sacking staff to stay afloat. With their existing funds depleting and no word on new capital, they are clueless about their future. So what went wrong? And what will it take for edtech startups to come out of this crisis?
As the pandemic receded, the business models of India's edtech startups have started to unravel. With schools reopening across the country, demand for online tuition has dwindled, affecting the revenue of edtech companies in recent months. The pandemic helped this sector as much of the country's $180 billion education sector went online. Companies rode a boom in the online education industry over the last 2 years as they bet big on the pandemic-related phenomena. Indian edtech startups raised $4.7 billion in 2021, up from $2.2 billion in 2020. This made the edtech space the third most funded Indian startup category, only behind e-commerce at $10.7 billion and fintech at $8 billion. But they are now laying off hundreds of employees amid a funding crunch and higher customer acquisition costs post-pandemic. While faltering investor sentiment and slowing funding rounds have affected startups in general, edtech companies are among the worst hit. So far this year, 9,000 employees have been laid off by 18 Indian startups, according to Inc.42's Indian Startup Layoff Tracker. Of these, 3,000 belong to 7 edtech companies, including Unacademy, Vedantu, and White Hat Junior, a subsidiary of Byju's. Just last week, non-academic upskilling startup Frontrow, which offers courses taught by celebrities, laid off 30% of its workforce, amounting to 145 staff. A couple of them, Lido Learning and Uday, have shut down altogether. Soumya Yadav, co-founder and CEO of 2.5-year-old Uday, said the startup shut down because business was not growing after the pandemic and not because of funding crunch. She said that as children went back to schools, the company faced roadblocks in growing the original model of online live learning. All-time high customer acquisition costs, low retention rates after the pandemic, and screen fatigue contributed to the shutdown. Unacademy co-founder Gaurav Munjal recently told employees to focus on profitability at all costs. The company's new goal is to reach profitability and generate free cash flow, he said.
What happened was that there was a endless supply of cheap free money. Now a lot of it got channeled into these edtechs with the premise and the assumption that online delivery will remain the mainstay. None of these edtechs cracked the unit economics. All of them were earning 100 rupees and spending 500 rupees to earn that 100. Now, as that money is beginning to get dry, for some of the smaller ones, it's going to disappear overnight. For the larger ones, it's going to come at an extremely high cost. Option left them is try to become profitable overnight. which is not going to happen. Now, in an organization where people don't understand what profitability means, it's like changing the DNA and bone marrow of that organization. See, in the VC community, changes colors the fastest. Till yesterday, hyper growth was their mantra. Now their growth is generating free cash flow. Any business will take 4 to 8 quarters to move from a hyper growth trajectory to a profitable cash flow positive trajectory. So schools were sooner or later going to reopen. Kids go to school partially for learning, partially for friendship, partially for bonding, and a lot of learning happens in that environment. Online education doesn't deliver even 1% of that.
By 2030, India's education market is projected to increase to $313 billion. The market size today of the edtech industry is about $2 billion. The opportunity is vast given India has the largest population in the world in the age bracket of 5 to 24 years, with 580 million people. India has over 250 million school-going students, more than any other country. The companies are embracing the hybrid model and innovating to scale up their offline presence because the market is still big. Byju's last year acquired 32-year-old Akash Educational Services in a $1 billion deal, marking its foray into the offline education market with 200 plus centers. It is investing over $200 million to open 500 brick-and-mortar tuition centers in the next 12 to 18 months on top of the existing 80. Unacademy last month announced its foray into offline learning with its upcoming Unacademy centers for competitive examinations. The first such center will be operational this month in the coaching hub of Kota, followed by Jaipur, Bengaluru, Chandigarh, Ahmedabad, Patna, Pune and Delhi. Vedantu is also reportedly exploring hybrid options. Ankur Pava, EY's India e-commerce and consumer internet leader, said most edtech players are working towards an omni-channel approach to improve learning outcomes and experience, create more stickiness and reduce the cost of customer acquisitions.
You went through a cycle of hyper growth. Sooner or later, investors will start demanding their pound of flesh. I, sitting on the other side of the table, felt bad when companies doing 50 lakhs of revenues could raise 500 crores as capital. And I said, I, as a company doing 250 crores of revenue, when I go out in the market to raise 100 crores, there are 200 questions asked to me. But raising $50 million was like walking to a pawn shop and buying a pan. They had a honeymoon for 24 months, or these cycles come every 5-7 years. 2 out of 50 survive and the others don't. There are certain skill sets which you can learn online. You can't replace a school with an online. See, even in supplemental education, in the test prep industry, we used to have 20% online delivery and 80% offline delivery pre-COVID. In COVID, that went to 100% online. Now, as centers reopen, the needle will not go back to either 80-20 or stay at 20-80. We expect that 60-65% delivery will go back to offline environment. There will be certain segments which will remain online, but that too also for a certain age group. You can't test an 80-year-old or a 10-year-old in an online environment. Companies which are sustainable, revenue generating, cash generating business models, whether it is offline, whether it is online, or a hybrid model, will survive and sustain. Now, what is that mix? And let the market decide for itself, let the customers decide.
So it is clear that big edtech firms with deep pockets are funding their hybrid move to stay in business. Some of them had made the right moves even before the pandemic started ebbing. Like other sectors where competition is stiff, the future belongs to those who can innovate while focusing on sustainability.
यार
मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Unlike the future of edtech sector, the outcome of this week's MPC meet looks almost certain. RBI Governor Shaktikanta Das has already said that expectations of a rate hike are a no-brainer as inflation is a major concern. And ahead of RBI's policy decision, OPEC Plus decided to increase the size of its oil supply hikes by about 50%. Our next report talks about these macro concerns in details and tells us how investors should trade.
In a bid to ease crude oil supply shocks and cool off prices, the Organization of the Petroleum Exporting Countries and its allies have decided to boost output by 648,000 barrels per day in July and August, higher than 432,000 BPD as previously agreed. Even though the increases were divided proportionally across the member countries, analysts said the supply increase was likely to be less than the announced volume. That's because Russia is included in the pact, which is facing sanctions. Russian output has already dropped by 1 million BPD since its invasion of Ukraine and is likely to fall further as the European Union's ban on Russian oil kicks in. Moreover, members like Angola and Nigeria are already failing to meet their existing targets. Given this, Paul Hicken of S&P Global Commodity Insights is skeptical on the bullish oil outlook.
But how many of those actual extra barrels that was agreed by OPEC Plus are going to come to the market? If you think, a lot of those members, not just Russia, have capacity constraints. They've already been, for many months, been struggling to hit their quotas. And that is not going to change anytime soon. So realistically, only Saudi Arabia and UAE have extra wiggle room and extra capacity to bring on those additional barrels. Now, that extra crude that's coming on, it's limited. It's probably not going to offset the lost Russian barrels. And it doesn't answer the question around the oil product tightness. Jet, diesel, and gasoline are all very tight. We've got summer US driving season. We've got pent-up demand from holiday season around jet. And diesel is, as many have been pointing out, it's very tight right now. And that is going to take time for refining to catch up. The extra crude won't matter much to that near-term tightness over the next few months. And so if you look at the oil market more broadly, it's a very strong bullish narrative still, regardless of this OPEC Plus decision. And while there is some hope that it keeps a little bit of a cap on prices, we saw back in March when prices, Dated Brent hit up to $140 a barrel. And that was just on the fear of sanctions. And now these sanctions from the EU are in place. There's that fear again, and it's maybe hope that the OPEC Plus move mitigates that in some way.
Hicken is also cautious on easing oil prices as he believes the real caveat to this bullish narrative is demand destruction depending on the global economic downturn. Nonetheless, a relief rally cheered global markets on hopes of peaking inflation. However, benchmark indices surrendered gains in a fag-end sell-off and closed flat last Friday. During the week, the BSE Sensex index gained 5.28 points. With this, it has gained over 5% in the last 3 weeks. However, the Nifty slipped 0.05% for the week, whereas the Bank Nifty dropped 0.95%. Going forward, last week's OPEC Plus decision and a pickup in high-frequency indicators for the domestic economy will put the spotlight on RBI's meeting this week. Markets are baking in a 35 to 50 basis point repo rate hike, with cash reserve ratio kept untouched.
Inflation is emerging as a major headwind for the economies and markets globally. The US Central Bank Fed is now on an aggressive monetary tightening cycle. Consequently, US dollar has strengthened and the US bond yields have gone up. This is negative for emerging market equities. Even though there is selling exhaustion by foreign portfolio investors, they can be expected to sell more at higher levels. This will put a cap on the upside to the market. RBI is certain to raise rates in the June MPC policy meet. A 35 or 40 basis point hike in policy rates is likely. Even a 50 basis point rate hike cannot be ruled out since the central bank would prefer front loading rate hikes to anchor inflationary expectations. This is unlikely to impact the market much since it is already known and discounted by the market. The market is relatively resilient because DIIs flush with funds are buying more than what foreign portfolio investors are selling. Retail investors also are supporting the market. So the market may exhibit strength even in the midst of headwinds from inflation and rising interest rates. Investors should focus on segments which are not impacted by inflation. That is, segments not impacted by higher input prices and rising interest rates. Services segment will not be impacted by inflation as much as manufacturing like FMCG, which will face margin pressure. Exporters will do well. IT, chemicals, pharmaceuticals, and textiles look good for investments. Financials and telecom are safe bets.
Overall, an eventful week is on cards for the market, with interest rate decision, IIP data, crude oil prices, and global cues acting as key triggers.
तुम इतना डर गए? अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Why do the shares of a company crash? There could be various factors. It could be global headwinds, poor quarterly showings, or something else. But did you know that at times a wrong entry on the keyboard by a stressed trader can also bring down shares of any mighty company and push the market to wild swings? It is known as fat finger syndrome. Let us know more about it.
It was one such wild swing at the National Stock Exchange, triggered by a fat finger which had catapulted Chitra Ramakrishna to the helm of India's biggest boss in April 2013. On 5th October 2012, the so-called fat finger trade had triggered a massive flash crash, wiping off about 10 trillion rupees of investors' wealth at NSE. NSE CEO Ravi Narayan had to pay the price, and the baton was passed to Ramakrishna, who later got consumed by another bizarre scandal. Moving on, last week the derivative segment on the National Stock Exchange witnessed a freak trade in the weekly Nifty 50 options contract, reportedly resulting in a loss of nearly 200 crore rupees for the trader. This is not just a one-off instance. There have been such freak trades caused by human error. They are called the fat finger trade. On Thursday, Bloomberg Law reported that the Citigroup could suffer losses of over $50 million after a London-based employee's fat finger trade caused a flash crash in European stocks last month. Citigroup is still in the process of calculating the exact loss. In 2018, Deutsche Bank mistakenly transferred 28 billion euros to one of its outside accounts, more than the bank's market value. Back in 2006, a fat finger error by a trader at Mizuho Securities in Japan caused the firm to short sell a stock in an error that cost the firm 40 billion yen to unwind. So, what exactly is a fat finger trade? To start with, a fat finger trade is a human error while punching an order. This can include entering a wrong value in terms of a price or quantity, or selection of the wrong execution action such as buy or sell. As soon as the freak trade gets executed, the price hits an abnormal level for a fraction of a second and then returns to the level where it should actually be. For instance, the recent June 2nd freak trade. the trader executed a large sell order in Nifty 14,500 call option at 15 paisa. In contract, the then quoted price of over 2,100 rupees as the spot stood at 16,600 level. Here the chances are that the trader might have selected the wrong contract. He or she may have wanted to place the sell order in either 14,500 put or the 16,500 call instead. The contract eventually closed at 2,139 rupees, resulting into a loss of nearly 200 crore rupees on the basis of the traded volume, according to various reports. Freak trades not only result in a loss to the trader who punched the order, but also others who may have placed the stop loss order to their open positions, as their stop losses may have got triggered due to the abnormal price movement. The exchanges and brokerages have made constant efforts to avoid such fat finger trades by placing some preventive measures. The exchanges and most brokerage houses have set filters to alert the traders while placing orders outside the typical market parameters. Similarly, the price movements are capped by placing of circuit filters and cooling off period.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The impact of fat finger is exaggerated due to algorithmic trading, in which traders use computer programs to flood the system with millions of orders within microseconds. That is all for today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.